I loved this business and real estate, and so I wanted to kind of stay involved in that, but there wasn't enough mortgage business to pay the bills, right? And so I leaned on a friend of mine that had just brought on a auction specialist, so I started going to representing clients and then eventually myself at foreclosure auction. So we'd provide funding and we'd spot deals, and as they came along, I started picking some of those up. So from 2007, 8, and 9, and into 10, I was doing some flipping. I flipped 13 properties in that window of time. Our average profit per property was about $35,000. So some were far better and some were far worse. But what that did was it gave me a really good look at what it took to turn over a property, take something that nobody wanted and turn it into something that everybody wanted. And I really started getting more and more busy with the mortgage world because the Federal Reserve came in and pushed interest rates down. There was a first-time homebuyer tax credit. So the phone started ringing again at the office, and so I didn't have as much time to go out and do the projects. And so I actually got into buying rentals because I didn't properly evaluate a flip, and ended up at the end and it really didn't have any margin. So I wasn't going to sell it for no margin. We put a renter in there, and that was the really the second rental property that I bought, and I didn't really intend for it to be a rental property, but it worked out. That one cash flows about $800 a month now, and I bought it 4 years ago. It's in Marysville. We used to call that Scarysville back in the day because you couldn't sell anything in Marysville in 2011 and 12. So things started getting better, and so I shifted from. So I looked at that property and I thought, okay, I liked flipping properties. We were making, probably $25,000 to $45,000 per flip, but it was a lot of work, right? And it was a ton of energy, ton of effort, and I felt like I really needed to be on site almost every day, or at least a couple times a week, right? And so as I got busier and busier at the office, I thought, I can't really do this anymore. And I held onto that property, and it was cash flowing at the time. I think it was about $7,000 a year. And so I thought, well, geez, if I could buy some more of those where they cash flow in 4 years what I would make on a flip, but then they would keep going and going and going, right? It was the gift that kept on giving, right? It was like I got to flip another property every couple years, but I didn't have to do the work for it. And so all of my properties are also managed by a professional manager. So when people say, oh, geez, I don't want to buy a property because I don't want to deal with the headache calls in the middle of the night with this plugged up toilet or whatever, I don't get those calls, right? So they probably happen, but I don't get them because I have a layer of insulation between me and those calls. So I looked at it and I thought, geez, I could keep flipping and pull my hair out and maybe have to hire a bunch of extra staff, or I could start identifying properties to buy and rent instead, and then slowly build that passive cash flow so that I wouldn't have to be out there at that job site, and I could still build that passive income. Because my goal was to get to passive income. My goal was originally to get to $100,000 a year in passive income. So we've got that now, and now the goals are quite a bit bigger. So as time went by, I just started adding more and more and more, and my philosophy shifted when Fannie Mae and Freddie Mac came out with a limit of 10 finance properties. So I don't know if you guys have run into that or know about that. With Fannie Mae and Freddie Mac, they won't allow you to have any more than 10 finance properties on your books. And so as you own properties and pay them off, well, you could free up another slot, but generally speaking, these are 30-year mortgages, maybe 15 at best. That would take a long time to free up a spot. So what I started doing was I started trading up. I moved from single family or condos, which were cheap and easy to buy in the beginning, to multifamily. And so now I've got 4-plex, 6-plex, duplex. We like to have more units. What it does, it allows you to have more units still inside that 10 finance properties, right? So if you had 10 single families, now you've got 10 units. If you have 10 4-plexes, now you have 40 units. It's the same for Fannie and Freddie. It's still 10 finance properties, okay? So there are mechanisms to go beyond 10, but the financing is completely different. So now what we're doing is we're leveling up, right? So this year I sold 2 condos. Both of them were owned with partners. The one we bought at auction for $67,000 and sold for $245,000 3.5 years later. So obviously bought at the right time. Transferred that one into a triplex in Everett that now cash flows about $1,200 a month. Turned half of a $67,000 investment into a $458,000 triplex. So that allows you to level up your game, and I really didn't put any more extra money into that. Does that sound exciting?
Super exciting.
Okay, good. And so I did that through a mechanism called a 1031 exchange. You guys know 1031 exchange? Okay, so a couple are no in there. Basically, it's a like kind exchange. You can sell a rental property. The money never comes to you. It goes to an intermediary. You pay them a few bucks to do so, and then you identify another property, buy that property. So even though you've sold the property, you pay no capital gains. So you're able to transfer all the equity from one property into the next property. And that's how I was able to move that one over. I paid very little for it. It went up in value. I was able to cash out $130,000 on that and move it into a good down payment on a much more expensive property. And then, like Oleg mentioned, leverage. Like, leverage is key there. What happened was I bought that property at a very low price, and it appreciated significantly. But what ended up happening is even though the value went up significantly, the cash flow on that property did not go up significantly, right? There's a limit to how much you can raise somebody rent before they move out, and then you got to re-rent it. And if you're trying to get too much, you're not going to get a renter, and so it's going to sit vacant. So we were kind of capped out with our rent on that, and it was cash flowing $600 a month. It was good, but it wasn't great. And for that money that was in that property, we knew we could basically take the equity out of that and go 4 times and make another purchase. Okay? So what that means is if you've got $100,000 in equity in a property that you pull out of, you can level that up into 4 times that amount, because that's a 25% down payment on multifamily. So in that case, you have to remember I owned half of this. So it was $245 is what we sold it for. So my half was about $120, right? So after commissions and taxes and all the other stuff, I netted out a little over $100,000. So I owned half of a $245,000 property with no mortgage. There was no leverage. Now I take it and put it into a property where I leverage, and I put it into a property I own solely at $450. So I take my real estate value from $120 and change up to $450. So what happens when the market goes up 10%? Instead of earning $12,000, I earn $45,000, right? So that leverage allows me to really improve my net worth. Make sense? Mm-hmm. Okay, cool. So this is an example of a property that I bought from a wholesaler, and I purchased it for $272. That's on the left side. Those are the numbers of what I did. Those are my down payment, closing costs, light fix-up, didn't need a lot of work at all. The rents were a little under, so we raised them up to about $2,200. The payment on that loan was about $1,000, so you add in taxes, insurance, and management, all that other sort of stuff. You got $1,488, right? So that net cash flow is $711 on that property. I also like to evaluate these properties, and this is actually in the back of your book, so if you want to take a look and follow along. I like to evaluate properties in a couple different ways. So you've got your cash on cash return, right? So we talk about that. That's pretty regular. And in the case of a cash on cash return, if you got $10,000 a year on a $100,000 investment, the math's pretty simple. You've got a 10% rate of return, right? So in this case, I like to also figure in the principal, because what is principal but payback of the money that you borrowed, right? And so now my mortgage went from, where'd it go? Oh, that's not. You guys see the mortgage amount? I don't know if I see it. Oh, new loan amount. So $262.5 is what I ended up borrowing. So every month, somebody else is paying $281 towards my principal on my loan, right? So now I have that much more equity in that property. So effectively, it's not money I can go buy groceries with or spend on another property, but principal is my money, right? So I like to figure that into my overall cash flow as well. Also, I like to figure in some appreciation too, right? We buy real estate not just for cash flow, but because I think it's going to go up in value. I usually use like a 4 or 5% rate of return, because what we're getting right now is crazy and awesome and everybody loves it, but it isn't likely to continue, right? That will slow down as time goes by. Probably. I don't know. Nobody knows. So the cool thing about the way I structured this though is I bought this with hard money, and I got a 100% loan on the 272. Now, I had to provide them with what we call cash secure deposit of $68,000, so 20% of that property. I put it in an account with the lender that I borrowed the hard money from. They sat on that. And then what ends up happening is I do a little light fix-up, I get the tenants back in there, and then I send an appraiser out there, and they look at the property and say, geez, you got a good deal at 272. it's worth $350 on the market, right? And so sometimes you have to spend a lot of money on fix-up to do that. Sometimes you just were in the right place at the right time, got a great deal, and you lightly fixed it up, got a good tenant in there, and it's worth a bunch more. So based on the $350 new value, I could get a maximum loan of $262.5. So that would allow me to pay off almost the entire 100% loan that I got, right? So what the benefit there is now I've really leveraged that property, okay? So I paid $272, I put $5,000 in fix up, I spent some money on some fees. So in this case, my net cash into that property was about $29,000. So $29,000 into a value property at $350, that's less than 10% in. Generally speaking, if you're going to go out on the open market, buy a piece of property, get a vanilla flavored lender loan, it's going to be 25% down, plus closing costs, plus fix up, plus everything else you need to do. After everything with this strategy, I was into it for 29% or $29,000. Okay, so it brings down the cash flow a little bit. It brings up the interest payment a little bit because I'm borrowing more money. But what it does is it greatly improves my net return, right? So based on this scenario, you've got net cash flow $711, but that's based on an investment of $78,000, right? So your percentage there is still pretty good, but it's not near as good as $450 on a third of the money. Does that make sense? Okay, cool. So I just did another one of these here recently. I tell you this because the deals are still out there. A lot of people work. I paid $315 for it. I put about $45,000 into it, and it appraised at $470. This is a property I bought in October last year. Just appraised this weekend. The appraiser was out there on Saturday. So these deals are still to be had, right? I don't want you guys to think that they're not out there. And Oleg's a great resource to help find those deals. They've got all the feelers out. There's what we call wholesalers out there. You guys understand what a wholesaler is? Okay. So a wholesaler is somebody that basically sends out a boatload of postcards. They put those signs out there. We buy ugly houses, right? Those guys are basically wholesalers. So they're looking for people that want to sell, that want to get out of their property quick. And then what they do is they tie it up. They write it up in a contract. And then oftentimes they don't even have the mechanism to be able to buy the house, right? They might have enough money for earnest money, but maybe they're not creditworthy, or maybe they don't have the down payment, or they don't have the fix up, but they've got the hustle, and so they put the deal in contract, and then they look to sell it to somebody else that maybe doesn't have as much time, right? I don't have a lot of time to identify these deals, so I'm happy to pay a wholesale a little bit of a finder's fee, if you will, to go out and knock doors and send postcards and do all that stuff. So here's the rates of return on that previous slide, right? So this is the version where you put a lot of money into it. This is the version where you leverage it quite a bit more. So net cash on cash return was about $700 on about $70,000, so it's 11%, pretty good. Doing it this way, 17.5, right? So if you're going to buy a mutual fund and you could earn 11% or 17.5%, which would you pick? Anybody? 17.5, right? Of course you would. So then you figure in your added principal, right? So in this case, again, this one's good, don't get me wrong. And if you don't mind leaving some money into a property, well, by all means, go for it. If you want to max leverage and max out your rates of return, with the principal reduction added back in, this is 31% on your money. With a simple 4% rate of return, which is very, very low, it jumps that up to 79% rate of return. Now, principal and appreciation are not money you can go spend, right? I don't want to have anybody confuse that, right? But if you look at an investment, if you look at a stock, right? You're going to go buy a stock, you can say, okay, I get a dividend. Dividend's great, that's like cash flow, right? That's net rent. But that's not the only piece of the stock. It's not the only reason why you buy it, right? You hope it's going to go up in value too, right? So when you buy Amazon 5 years ago, you're going to get a really great rate of return. So if we're buying distressed properties in a hot market, you're going to get a really great return. And if you can limit the amount of cash you put in through creative financing, you get an even better rate of return. The reason I do it this way is because I want to do it over and over and over again, right? So I've got 27 units now. Many of those were bought with the same money that I bought the previous one, right? So I buy one, I do this strategy, get my cash back, and I go out and put it to work again. So you don't have to have hundreds of thousands of millions of dollars to buy $5 million worth of real estate. You just have to get creative with how you do it and find great deals. Make sense? Mm-hmm. Okay. So establish your goal, right? So my goal in the beginning, again, was to have positive cash flow of $100,000 a year. I thought that would be just a good round number to get there, and shoot, we're there. So now I've upped my game, right? So I thought it was going to be 30 units to get 100,000. It turns out it was 27. Well, probably it was 25, but now we're at 27 and a little over. So yeah, my new goals, immediate goal is 250 units at $100,000 a month in positive cash flow. So I figured I better shoot for the stars. The other one was too easy to hit, and now we've got really big goals. I think I can do that in the next 7 years.